Investor darling ICICI Bank has been in focus since some time now, with several brokerages and fund houses upgrading the bank's target price. At this point, it comes as little surprise that Jefferies has maintained a buy rating on the bank, upping the price target by 4% to Rs 900 apiece, leaving an upside of 30%. The fund house reiterated that ICICI Bank is the top pick for it in the sector and believes that the primary reason for the upgrade is the bank's robust investments in technology. We do know that the bank has invested heavily in technology, digital and stack, with several analysts suggesting a meaningful difference against peers. The house, though, believes that the bank is at a crucial inflection point of leveraging this investment made in technology. The SME and business banking platform is expected to lead to better growth and profitability. Additionally, the solutions offered by ICICI on its digital platform are customizable, which will drive better service, competitive rates, and a wider network. Jefferies also found better comfort in the bank's underwriting approach this time around. The house therefore projects the bank to grow at a 24% CAGR over the FY21 to FY24 period and attributes the raised target price to these factors. Speaking more on the technology progress made by ICICI, we recently interacted with Mr. Hiren Vaid of Alchemy Capital, who compared the bank with the NBFC juggernaut Bajaj Finance, insofar as saying that both players were at the very top of the technology game in the financial services space. Further, in recent weeks, we have seen both Bank of America and Macquarie up their ratings on the bank. Speaking of performance in the last quarter or two, the ROAs for ICICI have seen a dramatic improvement from 0.81% to 1.42% at the end of FY21. Coming to costs, cost of deposits as well has fallen from 4.96% to 4.12% on an annual basis in FY21. Earnings for the bank have nearly doubled on both a standalone and a consolidated basis in FY21 and are expected to come in strong, with Jefferies looking at a 24% EPS CAGR over the next 3 years, as I did mention. Asset quality has also seen a steady improvement, with net NPAs falling from 1.41% in FY20 to 1.26% in December 2020, which stood at 1.14% at the end of FY21. The bank also has a COVID provision of 7,500 crores as of the end of FY21. The book value per share has increased 18% in FY21, and the current price to book at 3 still looks quite attractive when we peg it against its other private peers. The stock has been flat over the last 1 month and is up around 10% in the last 6 months. But year to date, the stock has performed 30%. While speaking about the company, it may also be worthwhile noting that the company has filed a case of cheating against Karvi stockbrokers promoter C. Partha Sarathi to the tune of 563 crores. However, this has not impacted the stock price much in today's trade. Overall, it seems the bank is standing solid among analysts and investors alike. And to give a little bit of background, this has been a difficult quarter for banks in general. So, for investors to not be perturbed at such a time is truly telling. A good story playing out, hopefully. Thank you.